LinkedIn and Pandora and Groupon soon to come are part of a hot tech IPO trend. But how long can the good times last? And what's it like to be an investor in these high-flying times? Andy Rappaport was involved in the formation of several VC-backed startups before becoming a venture capitalist himself. He's served on the boards of more than 30 public and private companies, and he's now a partner at August Capital, which manages $1.3 billion and has invested in more than 75 companies. Andy, welcome to Bloomberg West.
Thank you. Pleasure to be here.
So you're seeing the public going crazy over just a few companies, Pandora, LinkedIn. Is this enthusiasm warranted?
So I think up to a point, the enthusiasm is warranted. LinkedIn is a great company. Pandora has created a terrific service and a great brand, and we're all rooting for them. But I think what we're seeing now in the market response to some of the IPOs that we've had is just a function of supply and demand of publicly traded equity in these companies. There's been a great buildup through a dearth of a period of time where there have been very few companies that have gone public. We've had companies like Facebook and Groupon and Pandora, which have tremendous consumer exposure and appear to be defining a different kind of future. But other than some secondary transactions, which not everyone has access to, there's been very little opportunity to buy stock in these companies. And so with the recent IPOs we've had, with relatively low float, relatively few shares coming to the market, I think what we're seeing is a supply and demand imbalance. And I think it's going to take several more IPOs and large IPOs. I think it's going to take the lockup coming off some of the companies that are now public and much more float hitting the market before we know exactly where the values of these companies are going to settle.
Yeah, Pandora, though a very cool product, is still not profitable. Groupon is still not profitable. Does it seem a little bubbly to you?
It seems very bubbly. And the problem with bubbles is you never quite know where you are in them until they burst. And so right now, I think that the bets that are being made on some of the companies that are going public, if you think about the bets that are attached to the valuation, rumors that are circulating for Groupon, for example, and Facebook, I think that those are bets on market momentum and potential bets on those companies being able to kind of break out in ways they haven't yet. And so at the very best, these valuations reflect possible results that those companies could achieve in the future if they fully fulfill their promise. And at the very worst, what we're seeing is just excess euphoria, such as we saw in 1999 and 2000.
All right, let's get Cory to weigh in on this now. Cory?
Yeah, and when you look for companies to invest in yourselves, are you imagining that investors, because investors have this, as you mentioned, this literally insatiable demand for companies like LinkedIn and Pandora, and we're seeing that in the way these deals are going out. You can add in Yandex and RenRen and a lot of other names that have started to come out of the chute Fusion IO. Do you try to imagine those markets when you're making an investment? Because at some point, you've got to get liquid again.
So we as a firm have a terrible handicap as investors in that what we tend to look at are the fundamentals of the business. Our view is that it's really tough to figure out where the public market is going to be at any given point in time. And we tend to invest early in the companies that we invest in. And so we're investing 3, 4, 5, 6, sometimes 7, 8, 9, 10 years before we would anticipate bringing these companies public. And it's extremely difficult to predict, are we going to be in a strong public market overall? Are we going to be in the middle of a high demand state for equity in small technology companies? So our tendency is to look at the underlying fundamentals of a company and determine, is this something that we want to own, whether the market is up or down? Is this something that we think on the basis of its own cash flows can sustain the kind of value that would need to for our investments?
Let me stop you right there. I mean, cash flows, really? Free cash flows like that? I mean, that sounds great, but none of these companies have free cash flow.
So, well, we're a little old-fashioned in that regard. And sometimes companies have negative cash flow for a while, and the cash flow becomes very positive. But I think our tendency is to think about what these businesses can sustain. And what that causes sometimes is for us to miss investments in companies that are that can take advantage of markets such as we have now. But on the other hand, it causes us to miss situations where you have strongly negative cash flow companies that have no way to be financed. That's a
So let me ask you also, one of the functions that we're starting to notice of the secondary market was that companies would get seed money, and that now, used to be the last bubble, it would take 6 months and $50 million and a couple dozen guys to build a pets.com like e-commerce database before you knew if you had anything, and so you needed a big venture investment. Now 2 guys can do it on the weekend with rented servers from Amazon. Do you find the role of your investments needing to go much earlier or much later than they did in the last sort of era of technology investing?
You know, for a while, I think this has been the case, and I think it will remain the case for a while. There is kind of the disappearing Series B, Series C stage of companies. There are certain kinds of companies that can do that, companies that, you know, are able to take advantage of cloud computing and web distribution in order to at least prove that they can acquire some companies, some customers. What we have seen over the last several years is that upon showing that companies can acquire some customers, they then are able to raise a lot of money on the promise that they'll be able to raise to attract a large number of customers and then, you know, ultimately become cash positive. Right now, because we haven't yet seen, we've had a lot of companies that have been created, and we haven't seen what's going to happen to these companies 5 years from now, what their market values are going to be, how these investments have actually turned out. It's been a little bit of a gold rush, and as a result of that, a lot of the typical kinds of financings that we do have disappeared. Companies go from doing an angel round to a very large financing, but I don't think this is a permanent phenomenon. I think this is a temporary thing that it's going to get washed out of the system.
All right, well, we'll be watching. Andy Rappaport of August Capital, thank you so much for joining us.
Thank you very much.
Here on Bloomberg West.